Hello, everyone. I'm Zak Gardezy, the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner, private wealth advisor, and the host of Money Minutes, a weekly video series where I discuss the latest market events and my overall outlook. On this week's episode, we'll cover the latest inflation data and how this has impacted the Fed's upcoming interest rate decision, along with my views on the 10-year Treasury yields, mortgage rates, the housing market, and where I'm investing client capital today. So let's get right into it. So the latest CPI numbers show a modest 0.2% rise in August, bringing the annual inflation rate down to 2.5%, which is the lowest since early 2021. Now this confirms the likelihood of a 25 basis point cut at the Fed's meeting next week, but with core inflation higher than expected, a 50 basis point cut is seemingly off the table. Now importantly, hourly wages rose faster than inflation, outpacing it by 0.2%. Now, this is crucial as it means real earnings are increasing, giving consumers more spending power and really helping to sustain economic growth despite inflation concerns. Now, moving on to the 10-year Treasury yield. So it has been continuously hitting 52-week lows, and now it's sitting in the 3.6% range, down from a high of 5%. So, since the 10-year Treasury serves as really a benchmark for overall interest rates, including mortgage rates, we've now seen mortgage rates drop to their lowest levels since February of 2023. And this is really before any cuts from the Fed. So, as a result, the index that tracks home purchase applications has hit a recent 2-month high. So, while lower mortgage rates are spurring more activity, buyers shouldn't expect home prices to drop. In fact, with the limited number of homes on the market, prices may actually rise, which is a concern for the Fed as they look to avoid triggering another bout of inflation. So to recap, the latest CPI data shows inflation is slowing down to 2.5%, giving the Fed a strong case for a 25 basis point rate cut at their meeting on September the 18th. Now, according to the CME Watch tool, there's an 85% chance of that happening. But looking ahead, there's a 48.1% chance of a 50 basis point cut at the November 7th meeting and a 46.2% chance of a 25 basis point cut on December the 18th. So this would bring the Fed funds rate down to 4.25 to 4.5, which by the end of the year, that's a 1% lower rate than where we are today. Now, in my view, a sharp move lower on the Fed funds rate will be a tailwind for markets as it helps stimulate the economy by lowering borrowing costs and advancing economic growth. Now, the risk will be that inflation comes back, and if we see signs of that, I wouldn't be surprised if the Fed pauses its rate cutting program. Now, that scenario is a risk that investors should be really aware of as we head towards the later months of the year. Now, as I've said all year, I'll be focusing investments on high quality, large cap US companies. Now, additionally, I believe that lower rates create a more favorable environment for private equity investing, which is something I've discussed with Wealthstone clients where appropriate. Now, we're definitely not out of the woods yet. I think significant volatility is still on the horizon with the election and other market events. However, as the weeks go by, we'll get more clarity around the Fed's actions and other factors driving market volatility. Once those factors subside, volatility should normalize. Rate cuts should feed into the system, and it should be a good time for the market. And this concludes this week's episode of Money Minutes. As always, if you have any feedback or questions, or would like to have your portfolio and overall financial plan reviewed, please don't hesitate to reach out. I'll see you all again next week. Thank you very much.